All right, welcome to Talk Tickers. Tonight, we are digging into Capital One's absolutely stellar Q3 earnings. The stock just popped after hours, and you're about to see why. Management delivered a complete monster of a quarter, and it really looks like that big Discover acquisition is already paying off in a huge way. So let's dive right in.
Okay, right out of the gate, the headline number was just a knockout. We're talking adjusted earnings per share of $5.95. The street was expecting $4.38, so that is a massive, massive beat of $1.57 per share. In a market like this, a beat of that size, that's a huge statement.
So you got to ask, what was behind that big pop in after-hours trading? Well, it really boiled down to a powerful trifecta. First, you had that massive earnings beat we just talked about. Second, and this is a big one, their credit quality actually got better, which really calmed a lot of nerves out there. And third, they announced a huge new plan to return capital to shareholders. You put all three of those together, and that's a very, very bullish story. All right, so let's get inside the numbers and look at the core drivers. The headline figures were great, yeah, but it's the stuff underneath that tells an even better story about just how profitable this company is becoming, especially now that Discover is in the mix.
Okay, so here's a quick snapshot. We already know about that huge EPS beat. Revenue also came in nice and strong at $15.36 billion, a little ahead of what everyone was looking for. But what I really want to focus on here are these other key metrics: the net interest margin, the credit numbers, and that CET1 capital ratio. Honestly, this is where the real story is.
So let's start with net interest margin, or NIM. This is basically the profit a bank makes from its loans. And look at this. It jumped by a whopping 74 basis points this quarter, all the way up to 8.36%. So what's the driver? It's simple, really. They had a full quarter with Discover's higher-yielding loan book, and boom. This shows you the immediate power of that acquisition right on the bottom line.
Okay, now this was the big surprise, the one that really got the market excited. The domestic card net charge-off rate, that's basically the percentage of loans they have to write off, it actually fell sharply down to 4.63%. And management went out of their way to say, hey, this is way better than just your typical seasonal improvement. This one number did so much to quiet down all the fears about the consumer, and it's just proof that Capital One's underwriting is top-notch.
And then, to top it all off, we get this. The board authorized a new share buyback program for $16 billion. A number that big isn't just a number. It's a massive vote of confidence from the people running the company. It's them screaming from the rooftops that they think their stock is cheap and that they're going to be a cash-generating machine going forward.
Okay, so that was the quarter, but now let's talk about management's game plan, looking beyond just these numbers. After reporting a quarter like that, CEO Rich Fairbank really wanted to drive home one point. This wasn't a fluke. This is the result of a long-term plan that's really starting to fire on all cylinders now. And he laid it out pretty simply, breaking it down into three key parts. First, just keep plugging away at integrating the Discover network. Move their own card volume onto those rails and capture all those juicy revenue synergies. Second, use their modern cloud-based tech platform as a weapon, basically, to stay ahead of the competition. And third, go after the big fish. Double down on winning those top-of-the-market heavy spenders with their premium cards.
And this quote from Rich Fairbank, the CEO, it just perfectly sums up how they think about their business. He said, "We are in the 13th year of an all-in technology transformation, essentially building a modern technology company that does banking." As he explained it, this isn't about just slapping some new software on an old system. They've spent more than a decade rebuilding this thing from the studs up. They see themselves as a tech company first that just happens to be in the banking business. And that, right there, is their secret weapon against the old-school banks.
All right, let's switch gears to the Q&A session. This is always where you get some of the best insights, as analysts really press management on the details. And a few big themes kept coming up: the Discover portfolio, the health of the consumer, and how fast they're going to spend that $16 billion on buybacks.
Yeah, so Fairbank was pretty upfront about the Discover card business. He actually used the term growth brownout to describe the short term. And what he means is that because Discover was already tightening up on credit before Capital One bought them, growth is going to be a little sluggish for the next couple of years. But, and this is the key point he got making, the long-term story is completely different. Once they get Discover fully plugged into their own tech and their marketing machine, that's when they see a huge opportunity to really hit the gas and grow that business.
All right, a few other quick hits from the rest of the Q&A. On consumer health, they said things look pretty resilient, especially with their own credit numbers improving, but they're not taking their eye off the ball.
On premium card competition, they know it's a knife fight out there, but they feel like their Venture X card is in a great spot, especially while other guys are jacking up their fees. And finally, and this is a big one, they basically confirmed that they're going to pick up the pace on those share buybacks from the $1 billion level we saw in Q3.
Okay, so let's put a bow on all of this. We've gone through the numbers, we've heard the strategy, now it's time for our take, synthesizing this all into an outlook.
Which brings us to the big question, right? After a report like this, what's the trade? Has the stock already made its move, or is there still more upside here?
Okay, here's our official take from Talk Tickers. For next quarter's outlook, we expect this earnings momentum to just keep on rolling, with credit trends staying stable or even getting a little better. For the price action, that $16 billion buyback acts as a huge floor under the stock, and it should absolutely help push it higher. So, our rating is outperform. Look, when you combine this level of execution, improving credit, and a massive capital return plan, that's just a catalyst that's too powerful to bet against.
All right, now for our outrageous but plausible trade idea. Let's look at their capital. Their CET1 ratio, think of it as their safety cushion, is at 14.4%. Their target is only 11%. That means they are sitting on a mountain of extra cash. So, could they get even crazier with the buyback? We think it's absolutely plausible they could use some fancy financial footwork, like an accelerated share repurchase, to buy back a huge chunk of that $16 billion, like right now. It would let them take advantage of the current share price and get that capital returned before anyone starts worrying about the economy in 2026.
And of course, we have to say it. This is not financial advice.